today. We are thrilled that you would take your time to be with us today. My name is Cindy Wright. I'm the Director of EES Student Success and Wellbeing here at Gettysburg College, and I oversee a lot of different programs, and most importantly, I pay attention to our students' overall well-being, and that means financial well-being. And I am thrilled to introduce my colleague and friend, Kevin Smith, who is going to share with you some incredible pieces of information in the secrets to becoming wealthy. And then at the end, I'll pop back on again to share with you a free resource that we have for all Gettysburg College students that can set yourselves up for success financially now and in the future. So I will turn it over to my colleague, Kevin.
Thank you, Cindy, and good afternoon, everyone. It's great to be with you today. I'm sure many, if not most of you, have seen the game show, Who Wants to Be a Millionaire? And I'm here to tell you this afternoon that each and every one of you can easily become a millionaire, and you don't have to win a game show to do it. In fact, not only can you become a millionaire, you can become a multimillionaire. There's no doubt in my mind. You see, I work with millionaires each and every day. And yes, some are doctors, some are attorneys, business owners, or corporate executives, many with high incomes, as you would expect, but many are also truck drivers, factory workers, farmers, and those with relatively modest incomes. So I'm convinced from personal experience that anyone, regardless of occupation or income, can become wealthy. And that means you. In fact, you don't even have to know very much about investing to be successful. In fact, Warren Buffett says, if you have more than 120 or 130 IQ points, you can afford to give the rest away. You don't need extraordinary intelligence to succeed as an investor. Yet, despite not needing to have extraordinary intelligence to be successful, most investors are not. If you looked at the last 20-year period and you ranked the best performing areas of the market to invest from top to bottom over that 20-year period, you'll see that with the ability of hindsight, through 2016, the best place to have invested would have been the consumer discretionary sector, followed by small company value stocks. But at the other extreme, on the far right, you'll see the worst places to have invested in that 20-year period. The worst was commodities, which actually lost money, followed by Japan. Then you have inflation, and then you see this red bar over here, and that reflects the return of the average investor. The average investor barely earned a return that exceeded inflation and actually earned a return less than cash if you use 3-month treasury bills as a proxy for holding cash. So the typical investor does not perform well at all. Why is that? It's not that they aren't extraordinarily intelligent, because most are. It's just that they lack emotional intelligence. They make a lot of poor decisions, make a lot of bad mistakes. So much so that their returns are much less than the returns of the investments that they make. Let me repeat that. Investor returns are well below the returns of the investment that they make. Dalbar is an organization that evaluates investor returns and investor behavior. Over the 30-year period that ended in 2015, and the results would be very similar if we updated them to reflect current times. But over that 30-year period of time, the typical stock market investor earned an annualized return of 3.79%. In contrast, the return of the broader market annualized at 11.06%. So the typical investor underperforms the broader market over every single relevant time period, whether it's 20 years, 10 years, 5 years. In all cases, returns fall below returns of the broader market. And that's true not just of stock market investors, but also bond market investors who earn returns well below a comparable bond index. And this has nothing to do about the merits of indexing versus active money management. Even investors who invested in index funds that mirrored the S&P 500, for example, earned returns well below the index funds that they invested in. It's all about behavior. Another example, which I think is even more revealing, is that during the 2000 to 2010 timeframe. That's known as the lost decade. Stock market was relatively flat in that 10-year period. The best performing mutual fund, however, in that 10-year period was a fund called CGM Focus Fund. It was managed by Ken Huebner, and it annualized at 17% a year. So let's put that into dollar terms. You invested $10,000 in that mutual fund at the beginning of the decade and held it throughout. That $10,000 would have grown to $50,000. You would have made 5 times your money. They actually pulled the shareholder records and looked at the actual shareholder data of investors who owned that fund during that same 10-year time frame. Would you believe that the typical shareholder of that fund earned negative 17% during that same time frame? So instead of $10,000 becoming $50,000 if they would have bought and held throughout, $10,000 became $8,300. They actually lost money. The reason is the fund was very volatile. It only owned about 15 positions. There were times it performed very, very well, and in those periods, investors would buy the fund. Then there were times it was out of favor, it performed poorly. Investors would sell the fund, and they would do this over and over again. So much so that they actually lost money instead of making money like the fund did over that 10-year time frame. So it's all about behavior. In fact, Dalbar in their annual report said that 90% of investment results are based on investor behavior rather than mutual fund performance. For the 30 years ended December 31st, 2015, the S&P 500 index produced an annual return of 11.06%, while the average equity mutual fund investor earned only 3.79%. Recovering a portion of this shortfall would mean hundreds of billions of dollars earned by investors. Over and over, it emerged that the leading cause of the diminished return is the investor's own behavior. So again, let's put that into dollar terms. Typical stock mutual fund investor in that 30-year period, if they started with $10,000 and annualized at 3.79%, they would have ended up 30 years later with $31,000. And you might think, hey, that's pretty good. They tripled their money. But if they just would have invested throughout, that $10,000 would have grown to $233,000, 23 times their initial investment. So we know the typical investor doesn't do well because they make a lot of mistakes, and it's all driven by emotions and poor habits. So today, we're going to talk about what successful investors do and successful investors don't do so that you can be successful too. And specifically, we're going to talk first and foremost about developing good habits and also avoiding the common mistakes that most investors make. So let's start with developing good habits. There's only 2 of them, and they're very easy to remember. If you forget everything I talk about here today, I want you to remember these 2 habits. First, pay yourself first. I think many students have the mindset, especially after they graduate, that they'll save what's left at the end of every month after the bills are paid. You need to reverse that. The first bill that you write should be to yourself for your future. And you've got to automate it. It can't be a manual process. If you do that, you can spend all the rest. But the first bill you write should be to yourself for your future, preferably in a retirement account like a Roth IRA. Guess what happens then? Your spending will adapt, and you'll never miss the amount you saved. But if you wait to the end of the month, you'll inevitably spend what you have, and there won't be anything there to save and invest for your future. As Warren Buffett said, he took the words right out of my mouth. He said, do not save what is left after spending, but spend what is left after saving. So pay yourself first. Second habit, I want you to commit to putting aside just 10% of your annual earnings for your future. So 10% of what you make is yours to keep. You can spend the other 90%. All I ask is 10%. So if you make $30,000 a year, you'll invest $3,000. If you make $50,000 a year, 10% would be $5,000. You can do the math. You do that consistently from the time you graduate, the time you retire. You will not only be a millionaire, you will be a multimillionaire, no doubt in my mind. And if you're not convinced yet, give me a few minutes. Stay tuned. You will be. As Peter Lynch, famous mutual fund manager who managed the Fidelity Magellan Fund for many years, he said, in the long run, it's not just how much money you make that will determine your future prosperity. It's how much of that money you put to work by saving it and investing it. So becoming wealthy has very, very little to do with how much money you make, but everything to do with how much money you keep. So those are the two habits. They're very simple. Pay yourself first. 10% of what you make is yours to keep. Now let's talk about the common mistakes that you want to avoid so you can be successful. The first is that most investors wait too long to start investing. And the solution is very, very simple. You want to start right away, because time is your biggest asset to accumulating significant monies over time. You might think that retirement is years away. Why am I talking about investing for retirement now? Well, ideally, you should start planning for retirement as soon as you get your first paycheck. Because the sooner you start, the longer your investments have to grow. Now, you can retire at any age, but a common retirement age is age 65. That's when individuals are eligible for Medicare that covers their health insurance. It's also close to Social Security full retirement age. So let's assume that you plan to retire at age 65 and you were to commit to invest $3,000 per year. How much would you accumulate at retirement age if you start investing at certain ages? Well, in this case, we'll assume a 6% annualized return. If you began at age 20, $3,000 a year would grow to about $680,000. In contrast, if you waited to start until you're age 35, investing $3,000 a year at a 6% return would only grow to about $254,000. And lastly, if you waited till age 45 to invest, you'd only have $120,000 at the time of retirement. So those are huge differences. You want to start right away, because playing catch up later can be very difficult and very expensive. Let's look at it from a different perspective. Let's talk about the tale of two investors. We'll call them investor A and investor B. And let's assume that investor A began to invest soon after graduation from college. They invest $3,000 per year from the age of 21 through age 31, and then they stop after 11 years. So they contributed a total of $33,000 over that 11-year period. Investor B, on the other hand, decided to wait to invest until they were 31 years of age, invested $3,000 a year through age 65. So they actually invested over that 35-year period $105,000, considerably more than investor A. Assuming their investments earn 10% annually over that time frame, who has more money at retirement, investor A or investor B? Well, many people think investor B because they contribute a lot more money, invested for a lot longer time frame. Let's take a look and see what their results are. $813,000, not bad. How about investor A? Would you believe over $1.4 million? That's a difference of over $600,000. Why the difference? One reason and one reason only. Investor A started right away. So even though they only contributed $33,000, not the $105,000 investor B did, they end up with $600,000 more at the time of retirement just because they started early. So for all that investor A did right by starting early, they did one thing wrong. And that is they stopped. What would have happened if investor A didn't stop at age 31 and they contributed $3,000 a year every year throughout the age of retirement? What would they have then? Almost $2.2 million. And that's just assuming they invest $3,000 a year. Well, if we apply this 10% rule, which I mentioned earlier, we know that in your case, many of you, if not most of you, are going to start off earning a lot more than $30,000 a year. And you're going to have promotions, you're going to have raises, your earnings are going to go up over time. So if you commit to just 10% of your earnings, and you are investing more than $3,000, I'm illustrated here, there's no reason you can't obtain these numbers, if not more, if you just commit putting aside 10% of your earnings each year. It's very simple. It's very straightforward. So the key is time and compounding. Very, very powerful. Sooner you start, sooner you have your money to start earning and growing, getting compound interest. Getting interest on interest and growth on growth is very, very powerful. Sooner you start, the better, but it takes discipline, time, and patience. You make money over time, not overnight. And as Warren Buffett, in his typical wit and charm, once said, successful investing takes time, discipline, and patience. No matter how great the talent or effort, some things just take time. You can't produce a baby in 1 month by getting 9 women pregnant. So again, you make money over time, not overnight. Start early. Let's look at it from a different perspective. Let's assume that your goal is to be a millionaire. How much would you have to invest per month to attain $1 million over different time horizons? And in this case, let's assume that you earn 8% per year on your investments. Well, what we find is the sooner you start, the less you have to invest to achieve that $1 million goal. If you had 25 years to achieve that goal, you would have to invest $1,052 per month. But as your time horizon diminishes to achieve your goal, the amount you must invest increases. For example, if you had 15 years to achieve that $1 million goal, you'd have to invest $2,890 per month. Or if you waited 5 years to attain that goal, you'd have to invest $13,610 per month at an 8% rate of return. Now, those numbers just aren't realistic for most individuals, even those with high income. Now, I know what you're thinking. You're probably thinking even $1,052 per month is not realistic, especially starting off at an early stage of your career. But guess what? You have a lot more than 25 years until retirement. When you graduate, start your careers may last 40, 45 years until retirement age. So how much would you have to invest with a 40 to 45 year time horizon? Would you believe only $190 to $286 per month? That's only $44 to $66 per week. Are those numbers attainable? Absolutely. And there's no reason you can't do that, if not more, if you just commit to putting aside 10% of your earnings each year. Second mistake many investors make, especially at the early stage of their careers, is that they invest too conservatively. And it's driven by their fear of losing money, even though those losses are only temporary. As Milton Friedman, the famous economist, once said, there's no such thing as a free lunch. So if you want to invest in something that has very little risk, by definition, there's a very low corresponding return. Conversely, any investment that entails higher risk must reward investors with a higher return over time for the risk that they're assuming. So direct correlation between risk and return. It's a common law of investing. There's no getting around it. So if you want to have stability, you can do so, but your return will be very low. And if you want a high return, you have to be willing to accept temporary risk and volatility to do so. But the price we pay for the comfort of stability and being conservative is huge over many years. In this case, let's look at an initial investment of $10,000 and what it would grow to over a 25-year period at different rates of return. At a 4% rate of return, $10,000 would grow to just under $27,000. If you earned 8%, however, that $10,000 investment would grow to about $68,000. And at a 10% rate of return, it would grow to over $180,000. So those are huge differences. Now, naturally, we all would want to earn a higher rate of return, such as 8% or 10%. Well, how do we do that? Well, we can't earn those rates of return by being conservative. By definition, we'd have to increase our exposure to the stock market. You can do it in a prudent way, but only stocks are going to give us the returns of that kind. We can't get there being conservative and investing in things like bonds or money markets. So we can be conservative if we want to, and we can invest in things that tend to be more stable in the short run, but at a very, very high cost. We pay a very high cost for the comfort of stability. And that cost, even though a 1% or 2% differential rate of return doesn't seem like a lot in the short term, it's huge when you compound that over many, many years. Third mistake many investors make is that they have a fundamental misunderstanding of the difference between stocks and bonds. Investing doesn't have to be complicated. At its core, it comes down to one fundamental decision that you and other investors have to make. And that decision is this: would you rather be an owner or would you rather be a lender? Because that's all investing is. If you want to be an owner, you invest in stocks. If you want to be a lender, you invest in bonds. Because all bonds are loans. So if you lent money to a municipality, you would invest in municipal bonds. If you lent money to a corporation, you would be an investor in corporate bonds. Or if you lent money to the US government, you would invest in government bonds. But you invest in stocks, you actually are an owner in some of the world's best businesses. So if you own stock in Apple or Google, you're a part owner of some of the greatest technology companies in the world. And as those businesses do well, you will do well, and vice versa. So stocks are much more than speculative pieces of paper. They actually represent ownership in some of the world's best businesses. As Peter Lynch, again, the famous money manager of the Fidelity Magellan Fund years ago, said, although it's easy to forget sometimes, a share is not a lottery ticket. It's part ownership of a business. And if you invest in businesses that do well, you will do well, and vice versa. It's risk reward. Fourth mistake, and they're all somewhat interrelated, is that investors fail to understand how financial markets are priced, and stocks in particular are priced in the short term and in the long term. So think of it this way. I like to use analogies. In the short run, the stock market performs like an emotional pendulum, swinging back and forth between emotional extremes. On the one extreme, you have greed and optimism. On the other extreme, you have fear and pessimism. But in the long run, the stock market will always react based upon underlying economic fundamentals. But that's not true always in the short term, because on any given day, stock prices are just determined by supply and demand. So if more investors buy stocks than sell, stocks go up. And if more investors sell stocks than buy, they go down. It's as simple as that. And sometimes those reasons have nothing to do with fundamentals. It could very well be that a large mutual fund has a position in Coca-Cola stock, and perhaps they need to raise cash for investor redemptions, and they have to sell a large block of Coca-Cola stock that day. Well, when you put a large block of shares on the market at one time to sell, it's going to naturally cause the stock price to fall because supply exceeds demand. Well, did anything fundamentally change with Coca-Cola on that day that a mutual fund decided to sell a block of stock? Absolutely not. Still the same company it was the day before. It's just for supply demand imbalances, the stock fell. But many times these supply demand imbalances are driven by emotions. And when investors are feeling very confident and euphoric, demand is high, they buy more stock, causing the stock prices to go up, often at times well above what the underlying fundamentals would warrant. But it also works at the opposite extreme. They get fearful, they panic in times of market stress, causing prices to fall. So more people sell than buy, prices go the other direction and arguably overshoot, and drop to levels well below what we would anticipate based upon fundamentals. But in the long run, markets always react to the economic fundamentals. And the market will be driven by the rate of economic growth in our country. And I'm convinced the market will always go up for this reason alone. Our economy today is bigger than what it was 5 years ago. It was bigger 5 years ago than it was 10 years before that. And it was bigger than 10 years before then. And going forward, our economy, I'm convinced 5 years from now will be bigger than what it is today, and 10 years from then, and so on and so forth. So if you believe, like I do, that our economy, as measured by gross domestic product or GDP, will always go up over time, then by definition, the stock market must increase as well. Because gross domestic product simply reflects the aggregate amount of goods and services that we purchase each year from businesses that make up our economy. And so if our economy is increasing, as it has always historically, and as I believe it will continue to do, that means by definition, we're buying more goods and services from business throughout our country. Now, as we buy more goods and services, would we expect those businesses to be more profitable or less? Naturally, we'd expect them to be more profitable. And if those businesses are more profitable, would we expect them to be worth more or worth less? Naturally, we would expect them to be worth more. And that increased worth is reflected in higher stock prices, which represent ownership. So yes, we have these occasional divergences from fundamentals in the short run, but in the long run, the markets always react to fundamentals. And if you believe, like I do, that our economy will always grow over time, yes, we'll have recessions, yes, we'll have business cycles. But if you believe, like I do, that our economy will grow in the future like it has in the past, then by definition, the stock market must go up over time. As Seth Klarman, famous hedge fund manager, once said, the stock market is the story of cycles and of the human behavior that is responsible for overreactions in both directions. The key is to recognize when these emotional overreactions are occurring and to capitalize on them when markets diverge away from the fundamentals. As Warren Buffett once said, the key to successful investing is to be fearful when others are greedy and greedy when others are fearful. Did it ever occur to you that anytime someone sells a stock, there's someone on the other end buying it from them? And the same token, anytime someone is buying a stock, there's someone on the opposite end of the trade selling it to them. Now, at emotional extremes, more often than not, the person on the other end of the trade is someone like Warren Buffett. Successful investors capitalize on other investors' fear and greed. Ties into the next mistake investors make. They overestimate the risk of owning stocks and they underestimate the risk of owning bonds. So let me explain. If we look at the 90-year period from 1926 through 2015, and again, these results wouldn't be any different if we updated them through recent times. But over that 90-year period, the odds of making money on any given day in the stock market, if we use the S&P 500 as a proxy for stock market returns, would have been greater than 50-50, 54% chance of making money on any given day. But as our time horizon of investing in stocks expands, our odds of making money increase even more so. On rolling quarterly returns since 1926, the market's been higher 68% of the time. Rolling one-year periods, it's been higher 74% of the time. Rolling five-year periods, higher 86% of the time. Rolling 10-year periods, higher 94% of the time. And over rolling 20-year periods, it's been positive 100% of the time. In fact, there's never been a 15-year period in history where the stock market was lower 15 years later. So your risk of investing in stocks actually starts high, still less than a 50-50 chance you'll lose money on any given day, but starts high and then eventually declines and approaches and hits zero over time. But with bonds, it's actually just the opposite. Your risk increases with the passage of time. Now, keep in mind that all bonds are loans. So there's this mindset that if we invest in a bond, if we ignore default risk, there's this mindset that we can't lose money in bonds. So for example, if we invested $10,000 today in a 10-year government bond, in 10 years, we're going to get our $10,000 back and we'll earn interest along the way. Or if we invest $10,000 in a 30-year government bond, in 30 years' time, we're going to get our $10,000 back, and again, we'll earn interest along the way. Or do we get our $10,000 back? I would argue not. I believe that too many investors don't define money properly. Money to me should not be defined in terms of units of currency. It should be defined in terms of what those units of currency actually buy in purchasing power terms. And if you define money like I think it should be defined in terms of purchasing power, you can and do lose money in bonds, and lots of it. Because in economic terms, as we all know, we have this concept of inflation. simply reflects the fact that the goods and services we buy tend to go up each year in price. For example, Gettysburg College tuition costs a lot more today than what it did when I attended Gettysburg years ago. Same is true of a movie ticket, postage stamp, loaf of bread, a new car. Pick an item, they all cost more today than what they did in the past. And they will continue to cost more in the future because of inflation. So when we adjust a dollar for inflation, you can see what the effect is. Historically, inflation's been about 3%. That's its long-term average. Now, lately, it's been more than that, but over time, 3% is where it's been historically. If we adjust the value of a dollar for inflation, in 10 years' time, $100 today, 10 years has declined 26%. It's only worth $74 in present dollar terms in 10 years' time with a 3% inflation rate. And over a 30-year period, it's declined 59% in purchasing power. $100 in 30 years' time is only worth about $41 in present dollar terms. So I ask again, if you invest $10,000 in a US 10-year Treasury bond and it matures in 10 years, did you lose any money? Or in 30 years, you got your $10,000 back, but did you lose any money? Well, again, if you define it in terms of units of currency, you got the same amount of currency. But if you define it in terms of what that currency actually buys, yes, you've lost a lot of money. 26% in the case of a 10-year bond, or 59% loss of purchasing power in the case of a 30-year government bond. So again, the risk of owning a bond actually starts very, very low, but increases and becomes very, very high with the passage of time, just the opposite of investing in stocks. One of the worst mistakes investors make, and again, all driven by emotions, is that they stop investing during bad markets. But it's ironic that in these down markets, they make most of the money. They just don't realize it at the time. Ideally, you should commit to invest a fixed amount of money at predetermined intervals, weekly, monthly, or ideally, whenever you get a paycheck. And this is a strategy known as dollar cost averaging. With dollar cost averaging, we're simply investing a fixed amount of money at regular predetermined intervals of time. And it results in the purchase of more shares when prices are low and owning less shares when prices are high. It actually takes advantage of market volatility. Volatility works for you, not against you. Let me give an example. Let's assume that you decide to invest $1,000 a month, and you do that over a 24-month period or 2 years. And your $1,000 a month is going into either of two investments. One investment starts the period at $20 a share, and it actually stays at $20 each month throughout. So it begins and ends at $20 with no change each month. Another investment, however, starts at $20. It actually drops 50 cents a month until it bottoms about 1 year later at $14 a share, had a 30% decline, and then it recovers 50 cents a month and ends exactly where it started. Now, if you're investing $1,000 a month, which investment would you have been better off investing in? The one that stayed at $20 throughout, or the one that declined 30% and then recovered? Well, the investment return is the same for either one. It was zero. Both investments started at $20 a share and ended at $20 a share. So the investment return is zero in both cases. It's just how they got from point A to point B was a little bit different, but they both started at $20 a share, 0% rate of return. What did the investor earn who contributed $1,000 a month throughout? Would you believe about 18% on an annualized basis? And here's the math to prove it. $1,000 a month at different share prices shows you the number of shares that were acquired in those months. Over that 24-month period, they actually would have acquired about 1,427 shares. Those shares ended at $20 a share. They actually have $28,538 in their investment, despite only contributing $24,000. It's an annualized investor return of about 18%. Now, earlier I mentioned that typically investors earn returns well below the investments they make. In this case, it's the opposite. The investor earned much more than the underlying investment. Again, the investment earned zero, but the investor earned almost 18% annualized. Now, this is where the emotions come into play. The key was to invest continually throughout and not be deterred by market volatility. How does one think investors feel when they just had a 30% drop in their investment? When you're at the bottom, you tend to think that the market's going to just keep going down forever. And the mindset is that investors are tired of losing money, and they have the mindset that they're going to stop the bleeding, and they're just going to take their investments and move it to cash or stop investing altogether under the premise that they're going to wait till things get better and then they'll start investing again. Well, let's think about that for a second. They're going to wait till things get better. Well, how are we going to know when things are better? Are prices going to be higher than where they are now or lower? Well, when things are better, by definition, that means the market will have already recovered. So in most cases, investors who say, I'm going to wait till things get better and start investing again, the market's already fully recovered, so they've done more harm than good. They sold their investments at a low in the market. Those investments never had a chance to recover. And even worse, they stopped investing altogether when they could have been buying low. So again, it's all emotion, and the key is to stay investing throughout. Don't be deterred by your emotions. The market isn't going to go to zero. It will always recover. Every single downturn in history, the market has always recovered and achieved new all-time highs, and I'm convinced that will be the case in the future as well. So ironically, these dips in the market are buying opportunities. You actually make more money because there was a down market than if that down market never occurred at all. Yes, you don't realize at the time, but when the market eventually recovers, that will have worked for you, not against you. Whatever you do, don't watch CNBC. CNBC's objective, I assure you, is not to make you money, it's to make them money. It's all about ratings. It used to be that long-term was thought of as 10 years or longer. Now, I think thanks to CNBC and 24-hour financial news, it's more like 10 minutes. Because they cause investors to get caught up in the short term and all the noise, things that don't matter in the long run. So, as Jon Stewart once said, if I'd only followed CNBC's advice, I'd have $1 million today, provided I'd started with $100 million. Most successful investors I know don't watch CNBC for that reason. The key, obviously, to long-term investment success is to focus on the destination, not the journey. Don't be preoccupied with short-term results like the CNBCs of the world try to cause you to do. Focus on the long term, the destination, not the journey that matters. I'm going to give you another analogy. Think about why Wayne Gretzky was one of the best hockey players who ever lived. He's in the NHL Hall of Fame. He was successful because he skated to where the puck will be, not to where the puck is. Now, in your case, where the puck will be, what matters is where you are 40 years from now when you retire. What happens along the way is irrelevant. 40 years ago to this very day, the Dow Jones Industrial Average closed at a level of 850. Today, it's over 36,000. Now, let's put that into dollar terms again. Someone who invested $10,000 in the Dow Jones 40 years ago and left their money alone, invested throughout, that $10,000 would have grown to $400,000 40 years later, 40 times their initial investment. Now, was it a straight line? Absolutely not. There were numerous periods of time where the market went the other direction, and sometimes by large degrees. In 2008, the credit crisis, it dropped 37%. During the dot-com era from 2000 to 2. It dropped 55% from peak to bottom. Expect losses along the way, but the losses are temporary. Don't be deterred by them. Here's what to expect. What's normal is every 12 to 18 months, the stock market will drop 10% from some level. About every 3 to 5 years, it will drop 20%. And about once in a generation, typically you might have like a 30 to 50% decline. But every single time it recovered and hit new all-time highs, and I'm convinced it will do that again in the future. Predicting when these down periods are going to occur is not a recipe of success. Timing the market, you got to be right twice. Know when to get out, when to get back in. If you get it wrong on either front, you're just like the typical investor. You're better off staying the course, sticking with your plan. And if you do that, you'll be very, very well. Do not be deterred by periods of temporary loss and volatility. As quote I said once in the past, the key to building permanent wealth over a lifetime is to overcome the fear of temporarily losing some of it multiple times along the way. The one thing that successful investors have in common is that they have all endured extended periods of significant market decline. Let me give you another analogy. Visualize the stock market like a child playing with a yo-yo, riding an escalator. If you focus on the yo-yo, all you see is the ups and downs. All you see is volatility. The key to successful long-term investing is to focus on the escalator, not the yo-yo. The trend is your friend, the destination, not the journey that matters. Another mistake investors often make is they don't take advantage of free money. When you graduate and start your careers, many of you are going to work for employers who offer a retirement plan like a 401k. And many of those employers are going to match your contributions up to a certain percentage of your pay. They may match 25 cents on the dollar, 50 cents on the dollar. I've even seen companies match 100 cents on the dollar. Where else can you get a 25% to 100% rate of return with no risk whatsoever, just by contributing? Even if you put it in the money market, even if you want to be in something that's stable, you're getting an immediate high rate of return just by contributing through those matching contributions. Now, I wouldn't encourage you to invest in a money market for the reasons we just discussed, but just by contributing, you can get a 25% to 100% rate of return. So take full advantage of that. Do not leave any free money on the table. You also want to make sure you diversify. Don't want to put all of your eggs in one basket. Now, I recognize that there's a lot of choices, and investing can at times seem confusing. It doesn't have to be. It's really quite simple when you think about it, but there are a lot of options. It can be a little bit overwhelming. Even if you were to invest in the stock market, the stock market is made up of many different companies, and they all go through different cycles of being in favor or out of favor. There are small company stocks, there's large company stocks, there's value stocks, there's growth stocks, there's international stocks, emerging stocks. And I get it, can be a little intimidating, can be a little overwhelming. But when you invest in them, you want to do it in a prudent way and to diversify. This is a chart that shows for the 20-year period ending in 2017, it ranks the best performing areas of the market from top to bottom each year. So each of these colored boxes represents a different segment of the financial market. And as you'll see, there's really no pattern that emerges. It's all over the map. You know, anything that was best, like emerging markets for several years in the mid-2000s, then was subsequently the worst. You know, anything that might have been the worst subsequently was the best. Predicting this year to year is an exercise in futility. I have no idea from one year to the next how this relationship is going to unfold, but I do know you don't want to have all your eggs in one basket. You want to ideally have all these areas represented in your portfolio to some degree. So how do you do that? Again, it's very simple. Most of your retirement plans are going to give you choices, one of which is called a target date retirement fund. It's a mutual fund that has a year associated to it. And that year generally corresponds to one's estimated year of retirement. So in your case, if you take, say, 40 to 45 years from today, you'd be looking at a target date 2065 or 2075. If you invest in these target date funds, it's one fund, but it's really a fund of funds. There are many underlying funds that roll up together in that mutual fund. And they're basically giving you this diversification all in one fund. They're giving you small company stocks and large company stocks. They're giving you international value stocks and growth stocks all in one fund. They're determining the allocation on your behalf. When you're young, it's very aggressive. It's predominantly in the stock market, as it should be, but in a diversified way. And as you approach retirement and your time horizon becomes narrower, it will automatically adjust to become more conservative, as you would expect it would. It's all on autopilot. It's very simple, but it's effective. So again, investing doesn't have to be complicated. Don't be overwhelmed by all the choices you have. If they offer you a target date fund, go with that. Invest in it consistently year in, year out. You're going to be just fine. Or if you establish a Roth IRA or another tax advantage retirement account, they also offer target date funds. You know nothing about investing, but you want to invest prudently, just pick a target date fund. Again, you'll be just fine. And last but not least, as far as investor mistakes, don't spend money you don't have. Translation, don't go into credit card debt. It's the worst possible debt you can have. I've seen interest rates as high as 27%. Use a credit card for convenience. So don't carry a balance. If you have to use a credit card, pay it off in full each month. Don't carry a balance. I've never paid a penny of credit interest or debt or interest on a credit card in my life, and neither should you. It's the worst debt you could have. So don't get into that habit. Use it for convenience only. A couple of rules of thumb that you may or may not be familiar with. There's something called the rule of 72. You take 72 divided by your rate of return is how many years it takes for your investment to double in value. So for example, if you earned 10%, 72 divided by 10 is 7.2. It would take 7.2 years to double your money if your investment annualized at 10%. If you only earned 1% on your investment, 72 divided by 1 would be 72 years to double your money. But many of us are familiar with this rule of 72, but less are familiar with what's called the rule of 116. And that applies to how long it would take to triple your investment. Same concept, we just take 116 divided by your rate of return would be how long it would take to triple your money. So if you earn 10%, 116 divided by 10 would be 11.6 years. You would triple your money, 10,000 would become $30,000. Again, if you only earned 1%, it would take 116 years to triple your money. Now, I don't know if any of you have looked at a savings account lately and seen what interest rate you might be earning, but some of the rates I've seen are around 0.1%. So you're not getting compensated much in a savings account these days. Well, if we take the rule of 72 and take 72 divided by 0.1, it would take 720 years to double your money in a savings account. Now, I know we're living a lot longer, but we're not living that long. And that's not to say that savings accounts are bad. You should have a savings account. Everyone should have an emergency fund. Things come up. We need a rainy day fund. Car breaks down. We have a health event. We need to have money in the bank that's very safely invested. We can draw from at any time with no risk. Of course, the price we pay for no risk is a low return, but that's okay. But what I am saying is, do not put your long-term money in something that earns a rate of return like a savings account. It comes at a very, very, very high cost, as we showed earlier. And if you're investing for 40 years, again, the volatility doesn't matter. So do not use savings accounts for your long-term monies, but do have an emergency fund. It is important. As the author Robert T. Allen once said, how many millionaires do you know who have become wealthy by investing in savings accounts? I rest my case. Now, I know up to this point in time this afternoon, I spent all my time talking about wealth in financial terms. But I will tell you that being wealthy is much more than being rich. You perhaps have heard that money can't buy happiness. And I will tell you that that is true. I know many people who are very wealthy in financial terms, multimillionaires, but they're miserable. They're very unhappy. Conversely, I know many people with very modest financial means, yet they're so happy and full of life. Which would you rather be? It's an important question. To me, wealth is all about how you define it. It's a state of mind centered upon happiness and contentment. And it's also about doing what you love. Life is too short to do something you don't enjoy doing. When you think about where all of you are at this stage of your academic career, you're about to graduate, some of you sooner rather than later, but over the next few years, you're going to be starting your careers. And those careers generally are going to last 40 years or longer until retirement, consist of 8-hour days, 5 days a week, if not more. That is a very big part of your life to do something you don't enjoy doing. Don't just have a job. Ideally, find your passion. And if you can make that your vocation, you'll never work a day in your life. Aristotle once said, where your talents and the needs of the world cross, there lies your vocation. Now, who am I to question Aristotle? But I think he got one word wrong. See, to me, I think he should replace the word talents with passion. Where your passions and the needs of the world cross, there lies your vocation. Because you can be very talented at something, and the world might have a need for those talents, but if you don't enjoy what you're doing, you can still be miserable. But if you're passionate about something, you're going to inevitably approach it with enthusiasm and energy, and you'll develop those talents and do them very, very well. So ideally, find what you're passionate about and make that your vacation. And if you do, you'll never work a day in your life, because if you love what you do, it's not work. Julia Cameron once said, what we really want to do is what we are really meant to do. When we do what we are meant to do, money comes to us. Doors open for us. We feel useful, and the work we do feels like light to us. Money should be a byproduct of what you do. It should never be the primary motivator for what you do. Maya Angelou said, you can only become truly accomplished at something you love. Don't make money your goal. Instead, pursue the things you love doing, and then do them so well that people can't take their eyes off you. I love that. And when you become financially successful, which I know you'll do if you apply principles we talked about today. But when you become financially wealthy, don't forget the things that really matter. Trust me, it's not the money. George Lorimer said, it's good to have money and the things that money can buy, but it's good too to check up once in a while and make sure that you haven't lost the things that money can't buy. And lastly, my favorite quote, Henry David Thoreau. Wealth is the ability to fully experience life. Wealth to me, it's memories and experiences with friends, family, and those you love. It's finding meaning and purpose, pursuing passions, chasing dreams, and embracing life for all it has to offer. That's the wealth we all long for and hope to achieve. So my wish for each and every one of you, to find your passion, chase your dreams, become rich, but most importantly, be wealthy. Thank you very much. It's been a pleasure to be with you today.
Kevin, that was phenomenal. That was so great. I wish I had met you back in college when I learned this too. We have just a couple of minutes left here, and I'm going to take over the screen and share with you all a wonderful tool that was given to us by an alum by the name of Mort Creech. And Mort is the class of 61. And Mort felt that it was so important for our students to understand the importance of wealth and how to build it, that we chose iGrad is called for this tool. So let me switch over here, and I'm going to pull up this tool. So Kevin, can you see the screen right here?
I can.
Great, thank you. So on the screen, I want to teach you all where to find how you can get this free tool that has a lot of wonderful resources. If you go to Gettysburg College's website, can you see that screen, Kevin? Gettysburg College's website?
I can, yes.
Great. And you click on admissions and aid, and you scroll down the left navigation and you'll see financial well-being. You can sign in and create an account for yourself, and you can use your Gettysburg College single sign-on. And when you do, let me just log in here really quickly. Well, actually, to save time, instead of logging in, I'm just going to show you that what this tool offers. Can you see that, Kevin, the topics and stuff? Fantastic.
Yes.
So at the top here, you'll see this navigation bar, and there are various topics that you can use, like learning how to budget. There are a lot of articles that you can search for information and specifics that you're looking for. One of my favorite topics is all of these courses that it offers. It has courses that are advanced, courses that are beginner courses. It has how long the course takes. So it might be a 10-minute course or an hour course. It even gives you a certificate when you're done, even put in your little portfolio. The other neat thing is it has different tools here. So it can ask you what your money personality is. Are you more of a saver? Are you more of a spender? And if you notice this beautiful little button right here, scholarship search. So this tool, you'll definitely want to create an account and log in there and look at some free money that is out there that you might not have ever even known about based on this iGrad tool. And the last thing I want to share with you is there is an iGrad challenge that is going on right now. And when you click on the challenge, they are actually asking every month, it has a different theme. They'll ask you, you watch a little slideshow, it doesn't take long, and then it asks you a couple of questions, and then you get entered into winning $1,000. So if that's not worth you signing on to iGrad and creating your own account and exploring that tool, then I don't know what else is. So that's a great way to start you on your path to creating wealth. So on behalf of Kevin and myself and Gettysburg College, we cannot thank you for giving us your most precious commodity, which is your time. And so please know that we are reachable if you ever needed. Feel free to email me, cwright@gettysburg.edu, and I'm happy to help. And I wish you great success in the coming, welcoming you back to college and in the coming years. So thank you so much, everyone. Thanks again, Kevin.
You bet. Thanks, everyone.